The Sure Investing Podcast, investments and strategies to help you safely compound your wealth over the long run. Hey everyone, thanks for tuning in to the first episode of the Sure Investing Podcast. Today I'm excited to be interviewing Ben Reynolds, the founder and CEO of Sure Dividend, the company that backs the Sure Investing Podcast. Ben is deeply knowledgeable about investing, especially with regard to dividend stocks. He founded Sure Dividend in 2014 and has since grown the company to be a provider of dividend-focused investment research for thousands of self-directed investors. In this episode, we talk about Sure Dividend's quantitative investment strategy, the 8 Rules of Dividend Investing. Tune into the rest of this episode to learn about how you can use this profound wealth-building strategy that drives the research we do at Sure Dividend. So Ben, I just wanted to start by thanking you for spending some time talking with us on the podcast today. I thought we could start by rewinding way back to the beginning and asking you when you first became interested in investing and what the process for that looked like.
Absolutely. Glad to be here. For me, I first got interested in investing in college. When I started college, I didn't have a great interest in investing. I had a bit of an aptitude for math, and I also liked psychology. But I decided not to get a psychology degree, and I went with a finance degree. And in pursuing my finance degree is when I really started getting interested in investing.
And when did you start pursuing investing for yourself during that time period? Did you start buying stocks in college, or did that come later?
My first investing experience was actually, I talked to a financial advisor, and he recommended some mutual funds. And this was probably time-wise, this was probably my first or second year in college. And I talked to this financial advisor, and he said, well, are you high risk, low risk, or medium risk? And I said, I don't know. And he said, okay, well, we'll do one of each. And it was about a 10-minute conversation, and then he kicked me out of his office.
All right. Well, to my understanding, that is very different from how you invest today. And I think it's normal for most investors to go through an evolution over time as they learn and gain more experience in the markets. So my question to you now, I guess, is, was there ever a turning point when you realized that mutual funds wasn't the best way to invest? And more broadly, how would you say your investment philosophy has changed over time?
It was a big learning experience for me. So going back to being in college and taking a few investing courses, one investing course in particular in college really opened my eyes to and got me interested in investing in general. And that course, they discussed market anomalies. Things like low volatility stocks have outperformed with lower volatility, and that goes against what you'd expect in a market if the theories they were taught were true. And they discussed the value effect. They discussed the January effect as well, which is stocks tend to outperform in January. So there's all these things that I didn't end up using all of them, but it really got me interested in, okay, well, there's money to be made in investing. There's things that work better than other things. And why aren't more people taking advantage of these factors? Because in that course, the professor would say, no, if you take advantage of the value effect, that's not counted in your performance. Like we try to measure that and make sure that you're not rewarded for that. And my thinking was, well, if I had $100 and I made a 10% return and I have $110, that's better to me than if I would have made a 5% return and had $105 at the end of it. No matter what you said, like, oh, it's not fair, you took advantage of the value effect, I want to take advantage of that because I want to make more money. So that's kind of was the beginning of my process of being interested in learning about investing. And from there, the evolution for me was, when I started, I was interested in value investing in particular, deep value investing. And slowly over time, I've moved, I wouldn't say away from value, in that I, of course, think value is very important, but more towards a high quality, long-term perspective.
As you and I both know, there's lots of very famous and very influential investors who have followed a value or deep value approach. Now, with that in mind, are there any particular super investors that you would say have had a big impact on your philosophy?
Absolutely. I've studied a lot of different super investors, as you call them, people like Seth Klarman or Warren Buffett, and I've tried to borrow what I can from what's worked well for them. The person that's had the biggest influence on me is reading about how Warren Buffett invests because he's been the most successful over the longest period of time, and his investing strategies are also interestingly very applicable to a majority of investors out there. They're not as difficult as what Seth Klarman, as an example, does.
Now, when you think of Warren Buffett's investment strategy, just for our listeners who aren't necessarily super familiar with his approach, if you had to summarize his strategy, what would that look like?
Warren Buffett's strategy is to invest in businesses with strong competitive advantages and shareholder friendly management for long periods of time. And he wants to buy them at fair or better prices.
I think you hit the nail on the head with that. Now, for any listeners who aren't familiar with what Ben does right now, Ben runs a company called Sure Dividend, which is an investment newsletter provider aimed at helping people invest better through low-cost, long-term investing in individual stocks, which is very much in line with the Warren Buffett approach. So, Ben, I just thought we could take a minute, now that we're talking about your investment strategy, to explain the philosophy that you use for your newsletter recommendations and just the broad guiding principles that you follow at Sure Dividend.
Sure. Like you said, the purpose of Share Dividend is to help individual investors build high quality dividend growth portfolios. And we do that through investing in high quality businesses, strong competitive advantages that typically pay rising dividends over time. And to achieve that, like, where do you find these high quality businesses? Which ones are buys? We have a methodology called the 8 Rules of Dividend Investing. And those are 8 different rules that have either historically improved returns or reduced risk. And that kind of ties back into what my interest was originally with investing, back to that course in college.
So it sounds like the 8 Rules of Dividend Investing harnesses various market anomalies in conjunction with one another to create this kind of cumulative effect that results in superior returns over long periods of time.
That's an excellent way to put it. And, obviously we can't guarantee any type of returns, but these are factors that have historically done that, and we expect them to in the future as well.
Could you give us a walkthrough of the 8 rules and perhaps comment on maybe the academic basis or common sense philosophy that underpins each rule?
Yeah, I'd love to. With the 8 rules, a brief overview here. There's 5 buy rules, 2 sell rules, and 1 portfolio management rule. So we'll go through the 5 buy rules first. We'll start with rule number 1, the quality rule. And the ranking factor here is we're looking at the dividend history and corporate history of stocks. So if a company's been around since 1900 and they've paid rising dividends every year for 50 years in a row, that's something we value very highly because it shows that the business can withstand tremendous amount of change. I mean, the world was a lot different in 1900 than it is in 2018, and it's still paying rising dividends. It shows just the strength of the business and that it can withstand recessions, rising interest rate periods, falling interest rate periods, pretty much anything that's been thrown at it. And the reason we pick these metrics is if you look at the Dividend Aristocrats, which is an index comprised of stocks with 25 plus years of rising dividend payments, that index, it's very selective. First of all, there's only 53 stocks in it right now. That index has outperformed the S&P 500 by about 3 percentage points a year on average over the last decade. So these really established businesses, kind of contrary to what you'd think, is that, you got to invest in the fastest growing companies around to get strong returns. These established businesses are producing superior returns. And so that's the first rule, is the quality rule. The second rule we have is called the bargain rule. And here, the common sense idea here is you want to invest in companies that are cheaper than more expensive. Just, if you'd rather buy your house for $200,000 than $500,000 for the same house. And the metric we use here is dividend yield. And simply put, we're looking for higher yielding stocks instead of lower yielding stocks, all things being equal. And things aren't always equal, so we're not looking for just the highest yielding stocks, but we prefer a higher yield to a lower yield on average. The third rule is the safety rule. And here we're thinking of dividend safety, but we have a different twist on it. And this is kind of going into more detail here. You normally use payout ratio here, And we use share repurchase yield instead. And the reason for that is payout ratio can be affected by earnings variances that might not really be indicative of the underlying business. So we use share repurchases instead. And the idea here is that if a company's repurchasing a lot of its shares, it has a lot of cash to do so, and it has additional cash above what it's paying for its dividend. So if earnings or cash flows are ever reduced for a bit, the company has a buffer there and it can use the money it was using to repurchase shares to pay dividends. And the academic evidence behind this rule is the S&P buyback index has outperformed the general market by about 2.5 percentage points a year on average over the last decade, which again is very, very strong performance. Our fourth rule is the growth rule. And here, I think anyone would prefer to invest in a business that's growing versus one that isn't. And the distinction we want to make here is that you want to look for growth on a per share basis. So a company might be able to grow its revenue very quickly, acquire a lot of businesses, but at the same time, it's issuing a ton of shares to do so. And shareholders have no gain here. So we look for growth on a per share basis, and we'll look at either earnings per share growth, dividend per share growth, or book value per share growth. And the evidence behind this rule is stocks with growing dividends have outperformed stocks with stable, unchanging dividends by 2.4 percentage points a year from the period of 1972 through 2013. And then rounding out the buy rules, rule number 5 is the peace of mind rule. And here we're looking at volatility. Specifically, the lower the volatility, the better. And this is stock price volatility, so it basically just measures how bouncy a stock price is. Surprisingly, stocks with low volatility have outperformed the market as a whole by about 2 percentage points a year over the 20-year period ending in 2011. And we expect these trends to continue. These are just when the studies were done. So that wraps up the 5 buy rules, and we use all those as different ranking signals and factors. And together they help us create our top 10 rankings for our newsletter. And then, when you buy is a big determinant of the returns you're going to get. But holding and knowing when to sell is the other side of that. So we have 2 sell rules, and both of these rules, they're meant to be taken into effect rarely. We're not looking to sell quickly. We're looking to buy and hold for the long run. With that said, there are reasons to sell occasionally. The 2 reasons to sell are 1, if the stocks become very overvalued, or 2, if it's no longer growing and it has to cut or eliminate its dividend. So rule 6 is the overpriced rule. And we sell if the stock is trading at an extremely high price to earnings ratio. And the academic evidence there is the lowest decile of price earnings ratios stocks. So this is the cheapest 10% of the market, outperform the most expensive 10% of the market by an astounding 9 percentage points a year from 1975 through 2010. So that's really just a huge difference. And that's why value is extremely important. If you're investing in overpriced securities, you're likely to do poorly over time. So that's our first sell rule. Our second sell rule, we call it the survival of the fittest rule. And that's to sell when a stock cuts or eliminates its dividend. And this is another telling performance number. When a stock cuts or eliminates its dividend, those stocks have had 0% total returns from the time period 1972 through 2013 on average. So if you take up a strategy where you're only investing in stocks that have just cut or eliminated their dividends, you're probably not going to ever make any money, or at least historically that's been the case. So we recommend selling in the case a stock does cut or eliminate its dividend. And that also speaks to, if a company has to cut or eliminate its dividend, it's because the business is performing poorly. And very common sense, you probably don't want to be invested in poorly performing businesses. So those are the 2 sell rules. And then the final rule in the 8 rules of dividend investing is the hedge your bets rule. And the idea here is to diversify your portfolio, but probably not to the degree that most people diversify. Studies have shown that you get most of the benefits of diversification from owning just 12 to 18 stocks. I would say 12 is very much on the low side unless you're a very sophisticated and experienced investor. We probably would prefer a portfolio of closer to 20 to 30 stocks, reasonably spread out among different sectors and industries. And though that summarizes the 8 rules of dividend investing, with them, it tells you 1, what to buy and when, 2, when to hold and sell, and 3, about how many stocks to have in your portfolio.
Thanks for the fantastic overview of your investment strategy. I have 2 broad high-level questions for you. The first is about your second sell rule, the survival of the fittest rule, to sell when a company cuts or eliminates its dividend. When that happens, usually there's a tremendous amount of stock price volatility as the financial markets kind of get used to the new dividend payment that this company's paying. With that volatility in mind, how do you know exactly when to sell stocks after they cut their dividend?
That's a very good question. And that is something we look at too, is we'll often not recommend selling immediately after, but down the line a bit. And that's because there's usually a big negative reaction to a dividend cut, and rightly so, but it's often excessive. So the stock price will decline far more than you'd expect. And then we might want to wait for it to rebound a bit if the business isn't truly on the verge of becoming obsolete. Maybe the dividend was cut for more of a one-time thing, or it's more of a temporary type issue that we're not really confident with the long-term future of the company anymore, but we're not in an extreme rush to sell. In those cases, it might be best to wait for the stock price to recover somewhat before selling, so you can take advantage of that rebound.
The second question I had was about your portfolio management rule. If you follow the Sure Dividend newsletter strategy precisely, you'll eventually accumulate a high-quality portfolio of dividend growth stocks. And let's say, hypothetically, you get to the point where you have 18 or 20 stocks in your portfolio, and buying more stocks will cause you to over-diversify, or diversify, as some people would call it. What would you recommend to investors who are in that situation?
Well, that's a really good question. And so when you get to a point where adding additional stocks to your portfolio, maybe you can't follow them as well. So you're kind of at your capacity of what you're willing to stay up to date with a company. So there's probably, we'll say it's 20 stocks in this example. And you have your 20 stocks, and the next month comes around and you're ready to invest more money. What do? We recommend to invest in the highest ranked stock you own the least in your portfolio. So with these rankings, they tend to be fairly stable over time, and often companies will remain good buys for years at a time. So you can add to your smallest holding that you already have that's ranked highly, and you'll still be investing in a high quality business without increasing the number of holdings you have in your portfolio.
Awesome. That's fantastic advice. You've just given us an excellent overview of the quantitative factors that make a good investment. I'm curious if you'd be willing to place some color on what are the qualitative factors that make a business a solid investment.
Absolutely. Qualitative factors to look for are if you can gauge the management and maybe projects or companies they've run in the past. Have they had success, or has it been a disaster and they kind of got a golden parachute and came over to the next company? So that would be a qualitative factor to look at for sure, is the management, if they're shareholder friendly. And that's a completely different topic, well, related, but shareholder friendly doesn't just mean returning cash to shareholders. You can repurchase shares, and it could be a terrible move for shareholders if you're repurchasing them when the stock price is very overvalued. So shareholder friendly is more qualitative than something that can be really measured in a strictly quantitative fashion. On top of that, really assessing where a company fits in its industry and its future growth prospects is a qualitative analysis. It can't be done very effectively quantitatively. And a good example of this is if you look at Coca-Cola's history, they have a phenomenal history. Sales of their primary product, Coca-Cola, had grown for decades, but the industry and the feeling surrounding Coca-Cola and other carbonated sodas has changed, and they're selling less soda in developed markets now. They've counteracted this by moving into a broad range of other beverage products, so the company as a whole is fine. But if Coca-Cola were a single product company, you would really want to factor that in your analysis and not say like, oh, that this is great. They've expanded for 100 years and just extrapolate that indefinitely into the future if there's a good qualitative reason not to.
Excellent. Thanks for that overview. So anyone who's listened to this episode the whole way through now has a very good sense of how you like to invest money and how you recommend that others invest money. With that in mind, I was wondering if you could share where you're seeing opportunity in today's market and how you go about selecting stocks in a bull market that's been historically longer than most, and after a 2017 that returned more than 20% to shareholders of the S&P 500.
Yes, honestly, it's a very difficult market right now to find high quality dividend growth stocks that are at least reasonably priced. The reason is, as you touched on, the market's gone up, I believe, every year since 2009. It's just one of the longest bull markets there's been. The S&P 500 is trading at one of its highest price earnings multiples in history. So this is historically a very pricey time to invest. And with that said, with the question of where are we finding value now, where are we finding good investments, it's mostly stocks that have some sort of negative news story about them. Stocks are industries. A year to 6 months ago, to even 3 months ago, retail would have been a good example of that. There was a lot of pessimism in the retail industry. Some healthcare companies today still have a lot of pessimism surrounding them. The big pharmaceutical distributors are an example of that, where there's a price war going on in that industry. There's a lot of negative news coverage. You hear about the opioid epidemic a lot, and there's some lawsuits that probably aren't going to affect the long-term nature and strength of these businesses, but in the short term, they could cost them some money, and investors are overreacting to this information. So those are the type of situations that we're looking for right now, because that's where we have to look. And if the market weren't so pricey, we could say, hey, Johnson & Johnson's a phenomenal business. Let's invest in them. But that's not the case right now because of valuation. So we are having to look for businesses that are going through temporary troubles.
Would you mind sharing some individual recommendations that have been in recent editions of your newsletter?
Absolutely. Cardinal Health is a good recent example. Omega Healthcare Investors is another one. Energy Transfer Partners would be a third one, and they're an oil and gas pipeline that has had a lot of negative publicity about them, that was trading at what looked like about 50% of fair value, in addition to having a phenomenally high yield and having a long history of growth. So those are three, especially Cardinal Health and Energy Transfer Partners. There's a few others, but those are two that really jump out to me.
As we look ahead towards the horizon, do you see an above average possibility that we would run into a bear market or a recession in the near future?
I absolutely do, but I've thought that every year for the last several years. So a lot of people will say right now, don't invest, but I think there's an opportunity cost to not investing, a very big one. Like you said, the market was up 20% last year. So by not investing, you're missing those returns. While I do think there's certainly an elevated chance of a recession occurring, or a bear market, not necessarily a recession. Because when you look at just the elevated valuation multiples, you look at the U.S. economy, it's, 50 years ago it was growing very quickly. U.S. economy is growing slowly now, and it has for a very long time. So it's not like the U.S. as a whole is going to just grow itself out of its valuation levels. That's not going to happen. There's extreme debt levels too on a national basis for pretty much every developed country in the world. You look at the debt to GDP ratios for the US, pretty much any European country, especially like Spain, Portugal, Italy, Greece, and especially Japan. Japan's debt to GDP ratio is absurd. but that's kind of on a global level. But definitely the US valuation levels make me think that there's going to be a big bear market at some point. And then you factor in rising interest rates. As interest rates rise, real asset values should decline, everything else being equal. We've been in a 30-year run of basically lower interest rates year after year, and that's just started to reverse itself. So that should factor into lower equity valuations going forward. So to answer the question, I definitely see an elevated chance of a bear market, but as far as what to do about it, I think the best thing to do is to stay the course, and no matter what the market does, invest in quality businesses when they're undervalued and take what the market gives you.
You mentioned a lot of broad economic factors in your comments there, including interest rates, sovereign debt, and those kinds of things. What role would you say macroeconomics or economics in general plays in your overall investment philosophy?
It really doesn't play a role. Everything we do at Sure Dividend is bottom up. So we're looking at the individual business and not at the global economy. But I do find a lot of those factors interesting, and just kind of thinking about what will happen to the global economy and markets in general.
Peter Lynch, who is this super investor who ran the Fidelity Magellan Fund for many years, has this great quote where he says, if you spend 6 minutes on economics in a year, you spend 4 minutes too long. And that seems like that resonates with what you do at Sure Dividend.
Yes, definitely. That's a great quote, and that's pretty much how I feel about it. And that it's not, studying economics is not going to make you some sort of great investor.
Speaking about investing and the stock market, I thought it would be interesting to ask you, what has been your best and worst investment to date? Now, these could be stock investments or alternative investments or even non-monetary investments. I think people listening to this episode would be interested to hear your thoughts on that.
Well, that's an interesting question. So as far as non-monetary, I think possibly the best use of anyone's time as far as getting ahead in investing, business, or life in general is reading the work of people much smarter than yourself. To me, like you can go and read all of Warren Buffett's annual reports and all his letters to shareholders, and you can really pick up how he thinks and how he communicates. And that's incredibly valuable, and they're free online. So there's really no excuse not to do something like that. And just that's where a lot of my education has come from with investing, is just reading about great investors, different investing strategies, and then thinking about them. So that activity of learning from the most amazing people in any field that you can find through books is, I think, the highest return activity there is.
With all that in mind, do you have any favorite books or books that you would say have had an outsized effect on the way that you live your life and you do business?
Yes, absolutely. And I'll stick more with investing books here. But one to read that, if you're not familiar with the dividend growth strategy, is The Future for Investors by Jeremy Siegel. That's a phenomenal book, and it really lays out the long-term dividend growth strategy and lists out how successful it's been historically and how comparatively easy it is to accomplish. And as a third bonus, how you really don't have to pay any fees other than the rare brokerage buying cost when you take on such a strategy. So that's a phenomenal book to read for investing. A more in-depth book on investing is, I really enjoyed Quantitative Value, which kind of drives home the importance of a more quantitative system to remove behavioral errors in your investing, because we all have a lot of biases, and that will affect your investing performance if you can't overcome them. So a quantitative system is, you're basically building the rules of successful investing, and then you follow the output of that instead of saying, XYZ stock looks like a good investment, but I hate that industry because I think it's evil, or you have some other feelings about it, and so you don't make that investment. And maybe using an evil industry is a bad example. Avoid that one if you want to, but that would be one reason why you wouldn't make the logical investment choice. So yeah, Quantitative Value would be another one. And then I touched on The Essays of Warren Buffett is a book that it's more of a business book than investing, but it details all of Warren Buffett's annual letters to shareholders into a easy to follow format where they kind of build on each other.
Great. Thanks for all those fantastic book recommendations. You mentioned Quantitative Value by Tobias Carlyle as a great book for learning how to build quantitative investment strategies. I think that you're definitely right in that being a quantitative investor helps you to eliminate the behavioral errors that most investors make. Are there any behavioral errors that stand out to you as particularly dangerous for individual investors?
Yes, the single biggest mistake individual investors make is selling at the wrong time. If you look at there's been studies, one's by Barbara and Odine. There's been several studies on the performance of individual investors by getting mass data sets from their brokerage accounts. And individual investors massively underperform the market. And this is because they tend to, one, sell when stock prices go down, and then two, buy when they're rising. And this is, like buy low, sell high. It's the exact opposite of that. So the number one mistake or error I think everyone struggles with, because it's human nature to do so, is you see a company you've invested in, the stock price goes down. Say it's Walmart. Oh my goodness, Walmart shares are down. I'm down 20%. I need to sell because what if it goes down more? That's the exact opposite reaction you should have. If you have any belief that Walmart will be around in the next 10 or 20 or 30 years and that it'll be bigger, when the stock price goes down, you should look at that and say, Walmart stock's on sale. This is great news. I'm going to buy more. And so that's really the big mistake and kind of what's, I think, backwards in a lot of investors' minds.
I think you're definitely right with that. Are there any mental models or thought processes that you think are particularly helpful for avoiding those mistakes?
Yeah, I think that one of the best examples of that is the famous example by Benjamin Graham called Mr. Market. And that's where you think of the market as your business partner. And every day he comes in and he says, hey, I've got a price that I'll sell. You can either buy or sell our business for. And 9 out of 10 days, he's very reasonable and he comes in about where you are. But Mr. Market suffers from, we'll say, extreme emotional duress. And sometimes he gets wildly pessimistic and he comes in and he says, you can buy the business for half of what I was going to sell it for yesterday. And you can take advantage of Mr. Market in these situations. And other times he'll be wildly optimistic and he'll want to buy for twice what it's worth. And again, you can take advantage of Mr. Market in these situations. So I think that's a really powerful mental model to think of as the markets, as it's not something you have to do. It's just prices that are offered to you, and you can say yes or no to them. You are in control.
That Mr. Market analogy has been very influential for a number of investors, including Warren Buffett. It seems like a lot of the things that you've discussed on this episode so far have to do with long-term investing. And if you would, we've discussed in detail some of the benefits of long-term investing, but its implementation is the hard part. So selling early is a mistake that many investors make. Would you have any advice on how to avoid that?
Yes, it is difficult to see, the flip side to selling too soon if the stock price goes down is selling too soon when it goes up. And the idea there's several advantages to long-term investing, but I think the core idea here behind all of dividend growth investing and long-term investing and competitive advantages and everything we've talked about is to think of yourself as an investor who's buying a piece of a real business. And so then you're a partner in that business. And if you had started a business or invested in a real world business with a few partners, you probably wouldn't sell because hopefully it doubles in value. You wouldn't be like, I got to sell now. But that's what happens a lot to people in the market, and they don't look at the underlying business. Did it double in price because it's making twice as much money per share now? Because if so, there's no reason at all to even consider selling. It's just doing what it should be doing for you. So that's really the underlying idea behind long-term investing is to think of yourself as a business owner. And then the advantages there are, one, much lower transaction costs. Every time you buy or sell, you're paying your brokerage. There's a few brokerages now that have no cost, but there's still slippage costs where you're paying a spread there. Every time if you sell and you're up and it's not a retirement account, you're going to owe capital gains taxes. And that's another huge advantage is if you're a long-term investor, the money you would be paying in capital gains taxes is instead left in your investment to continue compounding for you. And so that's something that's really powerful as well.
Awesome. To close up this interview, I thought I would ask you if there's any one piece of advice that you would ask a beginner investor today who's just starting out, what would it be?
My one piece of advice would be to educate yourself by reading great investing books. And we talk about the future for investors. I think that's a phenomenal place to start. But that would be my one thing, is definitely, if you're interested in it, educate yourself, and don't think that, you're going to be amazing at it just because you just learned about it. You have to really educate yourself.
Awesome. I think that is definitely true, and it resonates with me. Thanks so much for your time today, Ben, and we look forward to having you again on the podcast in the future.
Thanks for having me on. I appreciate it.
Thanks so much for listening to today's episode, everyone. I invite you to check out our website at sureinvesting.co, see our premium investment research at suredividend.com, and also check us out on YouTube, where we publish videos under the name Sure Dividend. See you next time.